Take a look at your wallet. The cash you're holding buys nearly 10% less today than it did just a few months ago. From grocery bills to summer travel, the US dollar is rapidly losing its purchasing power. While a falling currency usually signals an economic crisis, the advisors inside the administration view this decline as a necessary correction. They are engineering this depreciation by choice. This is the Triffin dilemma, a paradox forcing the U.S. to run permanent trade deficits to supply the world with reserve currency. This imbalance crushes domestic industries. To break the cycle, the administration is pulling three disruptive levers: trade, immigration, and taxes. The architects of this reset are shielded from the volatility, but the resulting fallout will land directly on the balance sheets of average households. Lever 1 involves aggressive 45% tariffs on China and 35% on Mexico. The goal is to make the dollar cheaper relative to other currencies, giving U.S. exporters a competitive edge in foreign markets. Retaliation follows immediately. Major trading partners answer with in-kind tariffs that strike back at American goods and manufacturers. This bar chart tracks a quiet shift in global reserves. Foreign central banks are sanction-proofing their economies by selling U.S. treasuries and buying gold, which is now rising to rival the dollar as the premier reserve asset. ECB President Christine Lagarde confirmed the trend, noting that geopolitical tensions are the primary driver behind this historic central bank demand for gold. Using tariffs to force currency devaluation has a steep cost. It accelerates the global movement to abandon the U.S. dollar system entirely. The second lever targets the labor supply, with the mass deportation of an estimated 11.3 million undocumented immigrants. This removal instantly erases more than 5% of the total U.S. workforce. The result is a severe negative supply shock. Farms and factories lose their labor base, leaving equipment idle and forcing operating costs to climb as production slows. Combining forced labor shortages with higher import prices creates the classic conditions for stagflation: rising costs at the register paired with a stalled economy. The final lever involves massive corporate and personal tax cuts, projected to expand the federal deficit by trillions of dollars. The data reveals a stark demographic divide in these cuts. While the top 1% receive a windfall of $275,000, taxpayers in the bottom 99% see a negligible sliver of less than $2,500. To fund these cuts, the administration is eyeing a gold revaluation trick. By updating the 1973 statutory gold price to current market rates, they can magically create over $1 trillion in fiscal capacity without issuing new debt. This influx of deficit spending forces the Federal Reserve into a hawkish stance. To keep inflation from spiraling, the Fed must push interest rates higher, driving up the cost of mortgages and loans for everyone else. Funding tax cuts with phantom wealth and debt squeezes the middle class by making private investment and borrowing far more expensive. Pulling all three levers creates a volatile reaction. The dollar drops as intended, but the domestic economy becomes more isolated. High-income earners and select exporters remain protected. They benefit from lower tax rates and assets that gain value during the gold revaluation. Middle-income households face the full weight of the squeeze. They are caught between rising inflation, stalled wages, and high borrowing rates. The structural foundation of the global financial system, the absolute stability of the U.S. dollar, is fracturing under the pressure of this policy shift. Rewriting the rules of the world's reserve currency might serve a macroeconomic goal, but for most Americans, the result is a regressive tax on their daily lives.